So, without further ado, I would like to introduce our highly esteemed and distinguished moderator for this morning's breakfast, Tony Quattrin, Vice Chairman of Capital Markets at CBRE. Tony is a veteran of the industry. He's got extensive experience in real estate business, focusing on landmark investment-grade properties and development sites across Western Canada. He plays an integral role and is part of some of the largest and most recognized commercial real estate transactions in North America. And just one of his many accolades, he won 4 of the last NAIOP Investment Deal of the Year. He is a top-performing broker, and we are absolutely thrilled to have him this morning. He is a keynote speaker at various groups, including Vancouver Board of Trade, BOMA, NAIOP, and is regarded as one of our leading real estate investment specialists in Canada. We're so grateful to have you with us this morning, Tony. Please give a warm welcome to Tony Quattrin.
Thank you, Paula. I can tell you sitting there listening to all that, cannot believe you're talking about me. It only comes as being around for way, way too long. Thank you very much for that. Let's get the panel up, and we'll get this going right away. We're short on time, and we have lots of topics to cover. Thank you all. So thank you, Paula, for inviting me and to be here. Thank you all for coming out so early. I know it's tough. If this was one of your work from home days, thanks for not wearing your pajamas down here. I appreciate that. And thank you mostly to the panelists. These are transaction specialists representing an enormous amount of capital across our country. And as a reward for them agreeing to be here today, I'm going to give each of them the first 30 seconds or 45 seconds or so for some shameless self-promotion. So tell us a little bit about your organization, how amazing it is, and your role in it, and then we'll move on to the questions. Alex?
Thanks very much.
Can you hear me?
That's better. Can everyone hear me okay? Thanks. Hi, Alex Messina with Nicola Wealth Real Estate. We are the in-house real estate team for Nicola Wealth Management. We oversee an $8.5 billion portfolio of real estate in major markets across Canada and the US. We're in multiple asset classes. We're in multifamily rental, industrial, self-storage, office. We also own a little bit of retail and seniors housing. And our strategies involve acquiring existing assets as well as developing from the ground up. We also participate in merchant development opportunities with partners, some of whom are in this room and on this panel. And my role is acquisitions, dispositions, and working with our partners. Thank you.
Hello, I'm Vera. I'm Director of Investments at KingSett Capital. We are a private equity real estate firm focused strictly in Canada. We invest across the full spectrum of the capital stack with our mortgage and our equity strategies. And I lead our investments activities for our equity funds out west, and that includes our core strategy, value add, affordable housing, residential development, and urban infill. Similar to Alex, we cover all asset classes. We directly invest, we co-invest with our partners, and we generally look at pretty much anything across the spectrum.
And Vera, was it like $7 billion in potential this year?
That's right. So our value add strategy, we're now on our 8th iteration. We raised $3 billion, and we expect to deploy that in about $8 billion in projects in the next 3 to 5 years. And our current AUM across the board is about $18 billion.
Thanks. Jordan?
My name is Jordan Carlson. I work with Anthem Properties. We are a fully integrated real estate development, management, investment business with offices here in Vancouver, Calgary, Edmonton, and Sacramento, California. We do a lot of residential development, both to own and to rent, everything from single-family homes up to high-density mixed-use projects. We build commercial, shopping centers, industrial. We have an 8 million square foot income-producing portfolio that's primarily grocery-anchored shopping centers, industrial, multifamily, and a little bit of office. And we do land development. And my role at the company is overseeing our acquisitions team as well as the asset management platform. And I do some work with our capital partners as well, co-investing in all sorts of things.
Great, thanks, guys. So billions and billions of dollars to invest, all asset classes to look at, and a lot of knowledge and a lot of challenges for the group here today So we're all here to find out how we can prosper in what has been a very difficult market and leave here a little bit wiser and smarter. Last year was pretty good in the first half. I think that a lot of that had to do that we had our Outlook breakfast and everybody left knowing exactly what to do, and they did a lot. In the second half, nothing happened, so I think everybody kind of forgot. This year started out really slow, so I'm thinking after today, the market will pick up immediately once you have direction and guidance. So when I was little, some things you couldn't talk about at the dinner table: don't talk politics, don't talk money, and don't talk religion. So today, it's pretty hard since politics are the root of all of our problems. Money is what we're here to invest. And I thought maybe we'd get away with religion not being one, so 2 out of 3 not bad, but I read this morning that the Church of England is going to consider alternative pronouns for references to God. And I thought, man, she's going to be pissed off. Another thing when I was little is when around Thanksgiving time, we always watched TV. The cousins all got in the room and we watched TV. The adults were all in there making turkey and smoking cigarettes and drinking back in those days. And we always watched The Wizard of Oz. And it was terrifying. I don't know if this is going to work. There we go. Oh, there we go. There we go. And it was always very scary. And I always remember looking up and all the cousins were gone. They were hiding under cushions. I'd all be by myself. And I was just terrified of this movie. And of course, they were on their way to see The Wizard to get courage, heart, and brains. Our panelists here have already been to see The Wizard. And they were smart enough not to ask for just one, but all 3. So they're very wise. They're very courageous to invest in this very difficult market. And they have a lot of heart to stick with it. So we're going to see what the Wizard taught you and what we're going to learn. None of these are representative of the panelists, because that would make me Dorothy. And, as woke as I may be, and gender pronouns aside, I'm not going there. So in today's environment, what's frightening you the most? Let's start with the one question that's burning everybody's mind, really an easy one. Who's going to win the Super Bowl on Sunday? Alex?
I'm going to go with the Eagles.
Eagles. Vera?
The Eagles, sure.
Now there's someone who can think on their feet. Jordan?
Yeah, I'm totally unqualified. I don't really care.
Okay, there we go. I hope the rest of this goes better. So of the challenges we have, here's some: interest rates, inflation, regulation. Oh my, what's bugging you the most, Jordan?
I would say, interest rates aren't bugging me. They're it's thrown a brake on things for sure, as they're intended to do. And then regulation, in our city is always something we're watching, just because it changes ad hoc, on the fly, often without due process. So yeah, it's tough. I'd say that's one, especially in our business, that probably affects us the most.
Vera?
Yeah, so I'd have to agree, because, at the end of the day, inflation, that's a positive for our market. Regulations, we've been kind of played with that probably forever. Interest rates is sort of a current and very active thing that's really impacting how we can invest. And, at the end of the day, unfortunately, I wish that was the last rate hike, but, yes, the interest rate increases have controlled some basket of goods and services, but not a lot of others. And also, we just don't have the luxury of existing outside of our neighbors to the south. And, if the Feds decide to hike another 50, I really can't see us not following suit. So I'm still watching.
Alex?
How boring, but I'm going to say interest rates as well. I think when you look at last year and interest rates started rising quickly, it was kind of like you knew there was a car crash coming down the road and you didn't know if it was a fender bender or a 10-car pileup. So what are you going to do? You're going to pump the brakes. And I think that's what all of us did. And right now we're still trying to look. I don't think it's a 10-car pileup. What we're waiting for is interest rates to start leveling off. And I think at that point, we're going to be able to operate a little bit more fluidly. So really, interest rates have really, I think, sucked the wind out of the market right now.
Yeah. So I think that's fair. Lions and tigers and bears, oh my, we're afraid of everything. And that's been pretty indicative of the market, because pens have been down for a very, very long time. Trust me, my banker keeps reminding me of that. Interest rates, steepest rise in history of the interest rate policies ever in the world. We've got governments sticking their nose in it everywhere, trying to make things tougher, ban on foreign home purchases, just another reason for developers to stop building when we need more supply than ever. And government regulation, more of it. They're putting costs, they're putting time, they're putting permits, step codes, construction costs, all government problems. So you're right to be worried, right to be afraid, and as a result, we've got investments down. So, but you know, if you look at it, try to think of it a little differently and see if I can inspire you to maybe tell me if there's a way forward, even in the face of these interest rates and government interference. You know, if you look at the last couple years of COVID, really things do look pretty bad today if you look at some of the statistics. Canadian stock market down 10%, tech sector down 34%, goes directly to use of office space. Oil prices down 50%, house prices down 17%, and you get the picture, cap rates up over 50 basis points. But if you think back to a time, and I'll stick with my fairy tales and movies theme, Goldilocks, if not 2019 was a Goldilocks moment, did I have that? Did I miss that? No. Turning tides. So we have immigration. We have Bank of Canada seemed to have held rates on the last go-around. We didn't have the second slide, did we? Did we? It was there? Okay, let me go back. I want to show it to you because it's important. Here? Oh, there it is. So if with 2010 was the Goldilocks moment, can't mess up a good metaphor. If you turn 19, if we say that was the perfect time to buy real estate, that's when everybody was buying, that's when the world looked good, and we had record years, record sales just before COVID. We're up 24% in the stock market. We're up to 19%, or 19% in 10% of the stock market, 30% in the tech sector, 50% in oil prices. Sorry, 47% in oil prices, 33% in house prices. REITs are down just 3%, and real estate cap rates are up just 37% points. So it's not bad, but we're still sitting on the sidelines. So are we making a mistake there? We got immigration coming, a lot more people, 100,000 people in Vancouver last year, and I was at 2,700 homes delivered. Clearly, if real estate's about people, demand is there. Interest rates looks like they're starting to hold. So what's an investor to do? Can you go to your boards and your people and the capital? Does that change your thinking on buying and investing? Can we go ahead anyways? Is it time? Are we done, Vera? What are they telling you in Toronto? That's where all the big decisions are made.
Toronto says be optimistic because some good deals are coming, right, Tony? I mean, like, the reality is it's just a pro forma. So you're right. You know, a lot of real estate fundamentals have been amazing. You know, given our supply and demand metrics, we are actually pretty optimistic across all asset classes. But in comparison to 2019, and you know, we use leverage, the cost of our interest rate has like doubled and it's tripled. And because of inflation, our operating costs have also increased, and revenue hasn't increased enough to justify all that. And at the end of the day, my fund targets are still the same. So we are still investing. We haven't pumped the brakes, but I think what we're doing right now is we're trying to be a little bit more strategic. So we're kind of looking at, okay, well, everybody has different investment goals. Is there something that we can do, maybe an asset swap at this time where we're solving a problem for each other? Or is there, you know, unique capital? Is there a more creative way I can invest, like, for example, through an equity loan? So that's sort of what we're doing right now. And I think, you know, as interest rates peter off, and I do think if this higher interest rate environment is here to stay, there has to be some fundamental adjustment because, again, my fund metrics don't really change and my fund targets don't really change.
Is there a risk of that capital just kind of sitting there, floating around?
Well, you know, so KingSett was founded in 2002. We're on our 8th iteration of our value add strategy. Like I said, we've got our core fund, which about $5 billion. You know, we continue to raise more money for affordable housing strategies, our residential development strategies, and we've never actually sat on the sidelines. Like, historically, we've always deployed that capital in 3 to 5 years, so I'm not really concerned. It's just time.
Alex, I think it was 90 deals in 2021 and probably a lot less last year. What's it going to take you guys to get going again?
So again, I don't think we ever stopped. Real estate's a really important part of what we do as a wealth management firm, and it adds a lot of diversity. So it's helped, you know, in good years, it helps. In bad years, it helps. Our firm is really keen on growing. I think where we see the opportunity right now is really in near-term value creation opportunities, buying long-term net leased assets that have no growth. Like, it's impossible to manufacture any return, and that's what our clients care about. They look at the bottom of their statement, and they want to see, what's my return? Developments become more difficult. So opportunities where you can mark leases to market and create value in the short run, even though interest rates are increasing, I think are the most kind of compelling opportunity for us right now.
But you've been a lot quieter, in fairness.
We have been.
Yeah.
But to your point, is 2021, is that really a normal year?
I guess the question would be,
I don't think I can do 100 transactions again in a year. It's not good for my health.
it's good for mine. But is it a lack of capital available, or is it a lack of a will to invest it? Is it a caution on behalf of your investors, or the money just not there?
I think it's caution. I mean, I think real estate's been a huge attractor of capital to our firm, and that's why people come to our firm to invest. Our capital is all high net worth private individuals and families, and they like the ability to have real estate as part of their portfolio and wealth creation strategies.
Yeah.
So the money's coming. But I think in general, though, when you look at the different options across different asset classes, it's easy to sit on the sidelines for the investors as well. So we're seeing less capital inflows, which is natural, I think, in this environment.
Yeah, well, a lot of the investors in the private wealth sector are headline investors, aren't they? So the headlines haven't been pretty, so I certainly respect that. Jordan, what's it going to take? Are you guys just going at, you seem to be a little more bullish than the rest of the panel here. What can you talk
Always. I think, yeah, like I agree with both these guys. Like I think it's not so much that we're not willing. I think there's capital there to do it. I think, to Vera's point, when interest rates, inflation, taxes, whatever, they all, squeeze your margin, and so we're looking for a targeted return. And the issue is that when all those things move really quickly, you want pricing to reflect that added cost, and you want it to reflect maybe a little bit of the added risk you're taking with the uncertainty. And so it's just much harder to find a market because that's your view as a purchaser, but as a vendor, you're kind of going, like, do I really want to take that kind of discount because it might get better? And it's just a lot harder to get a consensus between the buyers and sellers. And the other thing that, none of us like to talk about, but I think there's an element of, when all that stuff moves so quickly, investments you might have made in the past 2-3 years are all of a sudden, like, your thesis has changed. And so you have to spend more time and energy and sometimes capital kind of fixing those. And so it puts the brakes on things. But by all means, like if there's a deal there to be done that we think we can make work. And the other side of it is, lenders draw back too. And so that kind of, it restrains how much you can do. But again, there's a good market here. There's really good fundamentals in a lot of asset classes. And as long as the pricing reflects, the risk and the return profile, I think like we're here to do a deal for sure.
Yeah, and we have to figure out where the balance in that marketplace is, because I think the difference between this is my fifth sort of market disruption that I've worked through. COVID was the only one that wasn't debt induced. And the difference between this one and the 2010 financial crisis is there was no money in 2010. Today, there's lots and lots of money. It's just not being deployed. So the banks are there. Their parameters are stiffer. They want more equity. So you're talking to Vera, and you're trying to raise more capital. So there it is. Talk a little bit about, get a little more granular, talk about each asset class, see if I can't get a deal going here somehow with these three talented investment advisors. I'm going to help you a little bit because I think my years of experience is probably more than all 3 years combined, and that's really tragic. But this is my favorite quote: "Tactics without strategy is the noise before defeat." So before we talk about tactics, like vendor take-back financing or getting into the equity stack in a different spot or topping up the rents, let's talk strategies. So you are all transaction managers. You want to deploy capital. That's your job every day. That's what you're under pressure to do. You're in meetings, and you're getting direction from these boards, these capital people that provide you capital. And here's a strategy that somebody would come up with. Don't buy anything where vacancy rates are expected to rise significantly in the near term. So, no office? We can't buy office? How does that feel? Are you going to sell some office? Are you going to sell it down? Are you worried about all these things that are happening in the office sector? I'll give you a couple of things to just think about. Tech layoffs. We see this headlines in all the papers, tech's laying off industry. Tech's been a big driver of demand in that market for a little while. This is this short term? Are people going to stop using their cell phones? We got, Chat GP2, or whatever it is, GPT. Amazing. So is tech going to come back? Everybody wants to work from home. Well, a lot of people here this morning, so none of these guys are working from home. So is that going to change the use of office space? Vancouver is the top market in North America when it comes to vacancy rates. That is our market. Of the pipeline here, it's tough to really read that, but basically it's saying most of the new space that's coming on is pre-leased, and a lot of that is net absorption. Our vacancy rate's only going from 9 to 12, and that's bringing on 4 million square feet of space, which is about 20% of the market. So the fundamentals look pretty good in office. And our rental rates are still holding, if not rising, better than across are these all markets? Across all asset classes. So, office. Jordan, you don't really buy office, but you might build it in the podium of your buildings. What's your feelings on office? Well, I'm going to save you for the housing market more, but you do build office and you do own it?
Yeah, well, I mean, we do build it. It's almost just like a necessity, policy mandated type of thing. Office is a bit like, I think we believe in office. I think office is here to stay for sure, especially if it's really well located and, accessible and close to amenities and all that stuff. It's just tough because we were in a situation where vacancy was so low and rates were, rising really quickly and people were underwriting on that basis. And there's been a lot of disruption in that. So it's just hard to find deals, like, again, where the pricing sort of makes sense. But I think people will come back to the office for the most part and it will be okay. I just think we're in a period of rebalancing, if you want to call it that.
Okay, Vera, traditionally big funds like yours, a lot of money to get out. Office has been a great place in the past to deploy that capital. They're big, chunky assets. They throw off a pretty good cash flow. They can be very profitable when times are good. What's the appetite, KingSett, for office these days? Do these fundamentals help you sell them on Vancouver as opposed to Toronto, where I hear the vacancy rate might be going to 20?
Yeah, so I'd say overall, we are a huge proponent of office. If you've ever met any KingSetter, like, we're all about being in office, and we're not just, tooting that because we're significant office landlords. It's, if you guys have worked with any, and I don't want to offend anybody here, but, any consultant that's been working from home, in the last little while, there has been a significant drop in terms of quality of service, and we've had to actually sit down in front of these groups and say, you know what? We've noticed a significant drop. If you're going to continue working from home and this is the quality you're going to deliver to us, we're just going to go to somebody else. So I actually don't think that this whole work from home was, fundamentally changed office. It was always coming. Like, I remember when HBC vacated their building in Burnaby and they're working from home, and that was years before COVID. So, I think this is an interesting time because we're kind of swapping to more of a tenant's market than a landlord's market. So when we're looking at new office investments, we really have to ask ourselves before, I'm looking at a Class B building, I'm looking at it at a price per pound basis because if someone leaves, I know I can slot someone back in. It's a different world now where I think landlords have to be more innovative. They have to think about, I actually have to fight for these tenants. And guess what? These tenants actually have ESG requirements, so maybe we actually need to start investing in these spaces. 1075 West Georgia is going to be zero carbon. I'm not the asset manager, so I forgot exactly when, but talk to Andrew Kirkham if you see him sometime. So we're investing more in our existing offices, which tells you, we continue to believe that's going to be used going forward. And we're still going to look at office, but, now underwriting is going to matter. Like, we want to know, who's your tenant in here? What's your CapEx coming up? So, again, it hasn't really changed our program at all. And for any of you that are not working in office, I hope you'll be back soon.
Office, so, when vacancy rates are up, there's going to be some rebalancing. I think there's going to be some opportunities, but that availability is now. If you wait until the vacancy rates drop, we get into balance.
I don't know, Tony, bring me something.
We know it takes a long time to build an office building. Cap rates are going to collapse. You're not going to be able to buy them. They'll be too expensive. If you want to get in, now is the time. Are you ready to take that risk, to jump in, get some capital out, and believe that the market is going to improve and all these people that are working from home are going to get back in those buildings?
Well, it depends what you bring me, Tony, right? I'm ready to look at something, but something else to keep in mind is we don't have a pool of capital where we have the luxury to sit and wait. So that means, yes, we believe that it's going to come back, but the clock starts ticking when that dollar comes out. I'm sure there's other groups out there who have a bit of a longer term horizon. So, unfortunately, I am restricted from taking risks where timing can make a significant impact. But if you're bringing me something with a tenant in tow and you're saying, hey, what, can you bring some capital to build it? That's a completely different story.
Alex, office, you own some? You gonna build
really
any
don't
more,
like
buy
office.
any more?
Yeah, we really don't like office. I'm half kidding. I think our strategy on office is different. We don't buy downtown office towers. We're not big enough. We don't like the CapEx. We don't like the inducements. Our sort of sliver of the market is really creative, smaller scale office, so Mount Pleasant, and also really scruffy, beaten down office that are on large parcels of land that are future development sites, so covered land plays. So we cover a different segment of the market. In terms of office rates, I don't see them kind of scaling in the next few years. I think it's going to be a tough couple of years. There's some proverbial dead branches that need to fall off the tree. Office will go through a right sizing, but I think long term it'll be fine. But our focus again is really on smaller scale, focusing on smaller tenant sizes.
So you're going to build an office building for your head office, so that's coming soon. So but that mostly taken up already? Is that not a spec?
Yeah, so we have a site at Cambie and 7th. It's the Robinson Lighting site. It's on the northwest corner. It'll be a 12-story mass timber office building, and Nicola Wealth Management will relocate from Broadway and Granville with their head office.
You have most of that space though, or is there some spec space in there?
No, that they'll probably take the entire building.
Take it all. So there's not really speculating there.
Different animal.
So we love office. You think it's going through some tough times. So Vera would buy office. Would you sell the nickel? Can I make a deal here to Vera?
We like Mount Pleasant.
You like Mount Pleasant, but it's office. It's all office.
It's creative office.
That's his creative office, expensive office. Still not going to sell it. I'm glad to hear it. You think my job is easy, you see? They don't like it, but they won't sell it. All right. Let's move on to, this is one thing, and this is what I was getting at with Vera, and we've already kind of touched on it, is, in Vancouver, what I've seen time and time and time again when these disruptive periods come is prices don't fall that much. So you're going to have to pay for that office building from Alex if you want to buy it. But it might become available, which in the good times it will not become available. And so your opportunity in Vancouver tends to be opportunity, and that's what you guys kind of need to keep your capital providers informed about and tell them long term they'll be fine. I think, at least that's been the history. So we're going to have some opportunities coming, and we'll see what the pricing is. Talk about industrial. You poor investment advisors looking to buy. Here's one of your board members being wise and wisdom. He's been around, or he has been around for a long time. Be cautious about buying anything where rental rates have tripled in the last year and a half, because, how high can they go? So that would tell you no industrial. Oh my God, your playing field's getting smaller. Jordan, what do you think about industrial?
I think it's great. I think, rates have skyrocketed, but I think we hit a tipping point, especially in Vancouver, and there's good fundamentals behind that. Our population's growing. There's no supply of it anywhere, and I think COVID really accelerated a lot of the effects, which led to that explosive rent growth. And maybe that'll run out of steam a little bit if the economy cools down and consumer spending falls. But given our supply-demand fundamentals, I don't see it going anywhere. So, I probably wouldn't buy something brand new at $25 rents at a 3 cap. But if there was rent growth structured into the lease and, the cap rate was okay and it allowed you to get to a reasonable IRR, I think it's still a really, really good asset class to invest in.
Would you still build it?
100%, yeah. Yeah, for sure.
And if you build it, and would you be comfortable leasing it up? Do you think would you sell it as strata, or would you lease it and keep it? And if you're going to lease it, are you comfortable that $25 rates are going to hold?
Yeah, I mean, we don't do a lot of it in Vancouver. We do a lot of this in Calgary, so I can speak to it a lot better there, and we feel really good about it there. Here, I mean, the land is expensive, and frankly, we're just probably not the group to build it here in a meaningful scale. But I think I would feel if it was, good accessible space, it was functional space, I think I'd be comfortable at a mid-20s rate right now for sure. Because there's not enough out there, and there's groups that have to be here.
Are you looking at any right now?
Not in Vancouver.
Not Vancouver?
No.
Vera, you're building some industrial with some partners, strata, selling it off at $700-800 a square foot. Are you some of it multi-level? Maybe talk about the multi-level market. Are you comfortable with that?
Yeah, I mean, we're invested in it, so we're obviously comfortable with it. And at the end of the day, it's all the scarcity story, right? I mean, if you got to be in Vancouver and you got to be in the core, there's sort of nowhere you need to go but up. I mean, the reality is pre-sales and strata industrial right now have been slow. I don't think I'm saying anything that no one already knows. But I think that market is going to come back because, we've got 450,000 people immigrating to Canada every single year. And, starting your own business in Vancouver has historically always been a good option. I think right now some people are probably in the sit and wait attitude because as an investor, a small base space, typically you don't want to, you want to buy too early. You're kind of waiting for the bottom. So I still believe in that. We're not worried about industrial at all. We think the fundamentals are still great. We'd look at industrial all across the board. Strata, I know some of our partners here have seen some pretty good success in the right locations, in the right market where there's still demand and there's no space. So yeah, overall still optimistic.
Something still buy it. Still confident in the depth of the strata market at $750, $800 a foot?
I think so, because I don't really see anybody in this room bringing that price down. So if you want to buy, that's the price you're going to have to pay.
But isn't all that buying, wasn't that fueled by individual businesses looking to have some rent protection so they would own their unit as opposed to worry about the landlord doubling or tripling their rent? And that was fueled by having a lot of cheap debt from BDC and other banks. And that debt's, as Jordan just said, has dried up. So you're still confident, who's going to buy it now?
Yeah, so, and that's sort of the model that we were running earlier, to take a look at that inflection point between your rent rate and your support. But at the end of the time, you also want to have security, right? So if you're going to be investing in your space as a small business owner, sometimes, and I hate to use the word culturally, I hope I'm not offending anybody here, but sometimes that's just a better option. And if you want to be there for 20 years, at the end of the day, it's not just your rent rate in the next 5 years, it's a longer term play.
Alex, you do a lot of industrial, both sides of the border. What's your feeling about the market here and in other spots?
Yeah, we say, let's be boring, let's do industrial. We really love industrial. What we like to do is buy existing small bay for lease product. And why we like that? Huge rental rate growth, and there's no new supply. Really all you're competing with is strata. So we've had really good success doing that in Toronto. Would love to buy more in Vancouver. And then building new product. I mean, I think what would be helpful in this market is to see industrial land prices soften a bit so that there can be more industrial lease product brought to the market. I think we've seen a lot of strata come online, but not a lot of new lease product, and that's where I think there could be an opportunity in the next year.
What about, you think you'll have industrials in the U.S. as well, right? Do you see that as a better market, different market?
It's a bigger market. So, I mean, we're in markets like Phoenix, Vegas, Dallas. I mean, those are huge markets by comparison to the Vancouver market. So there's a lot of good velocity. There's a lot more new supply. There's a lot more absorption. Rental rates are moving faster. So for us, it's not Canada or the U.S. It's Canada and the U.S. It's a great complement. What we can do in the U.S. though is build and buy like new high quality product. Tougher to do in this market.
So in those markets, I mean, strata, they don't do that there, right?
Doesn't really exist.
So it's kind of unique to Vancouver.
In Toronto, we're starting to see strata.
Are you?
They call it industrial condo product now in Ontario. Happened with some great success. We are now taking part in that strategy. I mean, when you look at the Toronto industrial market, there's 900 million feet. It's probably the third largest market in North America. I think there's already acceptance of strata residential, and that's usually what precedes strata commercial or strata industrial. So I think there's a lot of good runway for strata industrial in Ontario.
Yeah, I think, the statistics support most of your positions that you love industrial. I mean, we've got the lowest vacancy rate really in North America. In markets large, 150,000 square feet. Lease rates have grown almost 60% over the 3-year period, which is just insanity. Over $20 a square foot on average, 25 or more for new, as you guys are referencing. So very, very, very strong. And this is a case where, despite all the new supply, vacancy rates, it's almost all absorbed in Vancouver. You can see that, the dark is the absorption. So all that supply, all that absorption, and your vacancy rates are still hovering at below 1, and your availability rate, that's something you can deliver to the market, in the next year or something, you guys call it in industrial, just slightly above 1. So all the fundamentals say it's good. I just wonder about affordability. Are you comfortable again, Vera, that these guys are going to step up and buy it at those prices for much longer?
Well, I mean, I think we're also creating more efficient spaces. So, for example, when you're looking at $25 and, rents have tripled in the last couple of years, but before we were building 20-foot clear spaces, now it's 40. And, with technology, those spaces are more efficiently used. We are currently marketing marine landing at the moment. So, I'm still confident that we're still going to be achieving reasonable sales. But, at the same time, I'm also a bit of a realist here. Interest rates are expensive, but ultimately, I still think that we're in a supply squeeze, and in the right locations, there's still not a ton of product that we're competing with.
Yeah. Well, it's interesting. I think if we got a lot of industrial players in the markets here today, probably a lot of industrial brokers, and if you polled them and asked them if land prices were going down to make your business easier, I think you'd get a resounding no from most of those guys here. So it's going to be tough. So maybe being in Calgary is not the worst idea for going forward and in the U.S. But good luck with it. And I think it's an astute buy. And hopefully we can find more of it, and we can build more of it as we move further and further out. So Yeah, I think the biggest thing here, there's just not availability, as we said. There's just not land. We're okay on time, so I would maybe go deep. Do you think they're going to bring some land out of the ALR, Jordan? Maybe you're more local here, longer. Is that a solution? Is that something that might happen? Is it necessary?
I think it's totally necessary. And my friends and I at NAIOP are working to make that happen. I appreciate the need for agriculture, but I think you fly into Vancouver and you see all that space, and I don't know, are blueberries that important, or do we need jobs and industrial space built? It feels like a very dated policy.
I think they're working on a way to get blueberries to fuel your cars, and then they'll have value.
Yeah, I don't know. Hey, we need agriculture, but yeah, I think it would be the height of stupidity to not pull some of that out of there and free up some space. Yeah.
Yeah, there's certainly certain pieces of land you can look at and say, what are they thinking? They haven't grown or harvested anything off here in 25, 30 years, probably not ever going to, but yet there it remains. So, Alex?
Yeah, but I mean, who wants to spend the time and energy right now, right? I mean, I think.
Look how profitable it could be.
Well, I mean, I think there's so many fish to fry. You got to really figure out where do you want to spend your time, and it's trying to get any project approved, right? So, do you really want to spend your time to get land out of the ALR?
How about buying some farmland and just waiting?
We have patient capital, but maybe not that patient.
Not that patient. Yeah, you've been around BC a long time. You get the politics, no question. All right. So carrying on with our asset classes, I think, we could talk about industrial forever. It's going to be solid and strong. We just got to figure out how to make it work in Vancouver. We're getting into retail. Back to your jobs as transaction managers that need to buy and sell real estate, and you get a strategy from your board, these wise old people that have been around forever. Don't buy real estate where new technology can disrupt the underlying uses, so e-tailing and so on. Jordan, I think we'll spend some time with you here. I think you guys own 70 shopping centers or something like that. Is that right?
Yeah, about that, yeah.
So clearly a believer. Did we sell all those too?
Most of them.
Just kidding.
Most of them.
Just kidding. So your views on it, this is a concern, everybody's going to have home things delivered to their house. They're not going to go shopping anymore. You're going to buy online, all that. So,
yeah, I like it. Is it disruptive? Sure. I mean, we don't really have that kind of retail. We've owned grocery anchored retail since I was, a little kid and knew nothing about any of this. And I think through various economic, tough times, good times, it's always held in there. It's certainly never been a problematic part of our portfolio. And so, yeah, we'll still buy it. We still own it. We really believe in it. It's done very well. It did exceptionally well through the pandemic. We build it. We do a lot of master plan mixed use, and we believe, retail at the base of residential is a really good use, both for the residents, but for the community. And I just, there's a balance there. I would hate to live in a world where I couldn't, get my car, walk down to a shopping center and pick up something I needed, to have to order a, carton of milk or whatever. Or it's crazy to me. And I also think, there's a fundamental human need for some connectivity and attachment and vibrancy that comes with retail, and it's an experience, right? Some more fun than others, but yeah, I think it's here to stay. And again, it's been a really strong cash flow producer for us for years and years and years.
And you're going to buy, let's go, I'll come back. Vera, retail, does that fit in your portfolio? Is there a need or desire, an asset class you'll consider?
Yeah, so, it's already in our portfolio. Our core fund, I think about 16% of our value is retail, and that includes enclosed shopping centers and includes retail strip malls. And, same as what Jordan was saying, if I need to go buy a carrot, I'm probably going to go to a grocery store. I don't think that's going to change anytime soon. We have started investing more in our enclosed shopping centers, creating kind of almost like a DJ sort of vibe for the stroller moms in our food court. When I go to the mall at Pacific Center, even I'm not a huge mall people person because it's just too many people, but there's still a lot of people that are actually there. It's some form of entertainment. I think retailers have already been dragged through the mud in the last couple years, and a lot of them have already kind of started to innovate. They started to realize that bricks and mortar acts as a complement to online shopping, and they're kind of pivoting it to become more of an experiential and sort of almost a marketing solution. So, I think retail is now you got to be extremely selective who your tenants are when you're looking at a building, but for sure there's still a place for it in our portfolio going forward.
The statistics bear that out, and I'll get to you in a second, Alex. But I mean, if you look at retail, so in the retail, rates, sales are stabilizing since 2021. Obviously, that was a very anomalous year because of the pandemic. People couldn't go out. This is an interesting slide. It's really hard to track retail vacancy rates across the country because nobody really keeps them. There's a lot of storefronts. There's a lot of podium retail, as Jordan talked about. But this is several billion square feet of shopping centers across the major Canadian REITs. This represents a whole cross-section, almost entirely strip malls, food anchored. We're over 97% occupancy in that asset class. And I do this graph, update it every year, and it never changes. So yeah, I think it's very, very solid. So what about a straight investment, Vera? Would you buy a food anchored strip? Jordan, I don't have to ask you. I think the answer is yes.
I'm looking at a couple right now.
All right. Do they have to be in major metropolitan areas, or will you go to outlying areas?
Yeah, so ideally we're kind of an MTV focused firm. I mean, we do look at secondary markets if they have the right fundamentals, but as always, my preference is to stay closer to core.
Yeah. So that leaves a lot of opportunity for Jordan to buy them in secondary communities where he's been prolific. Do you still like those markets?
For sure. I mean, it's so like I'll put a caveat, like not all of those markets, like some of them are sort of, you see the population declining every year and we kind of want to stay away because you don't see it. But a lot of our secondary markets have some population growth, right? It's really, really expensive to live in some of the big cities in Canada. And there's a good lifestyle there, so people go there and they need alcohol and groceries and they need to get their prescriptions and all that stuff. So, and that's where, there's the market's usually less frothy, so you can actually get some yield. And we don't underwrite for any rent growth, but they can be pretty good, steady cash flow producers for sure.
Alex, retail, you were active in it. You are active in it.
Yeah, we haven't bought a retail center in about 10 years. We now own 2 retail centers. Some maybe think that's too many, but I actually think the carnage has already been suffered in retail. Like if you've survived the shift to e-commerce and the pandemic, like the stable house of retailers, we feel pretty good about. So I could see grocery anchored retail as part of our strategy going forward. And part of the reason we like that is that it's a covered land play. A lot of these are on large pieces of land and there's future intensification opportunities. So we're maybe not as traditional in the sense that we look at it from just a rental rate growth perspective, but there's a lot of great uses. We're in self-storage, we're in seniors housing, we build multifamily rental, and a lot of these sites, they're well located and they can be future redevelopment sites.
Yeah, for sure. So retail, would you sell those last two that you have? Because Jordan will buy them.
I don't think so.
No? So a portfolio of 2.
I think we're going to grow. That's going to be an area of growth for us.
Good. Yeah, I was just on a recent trip to Toronto. I found that very interesting. We always have many meetings when we go there and just kind of talk to people in like speed dating, find out what everybody's doing. And retail sales are up in all categories. E-commerce is still growing, but 97% occupancy across Canada. So it's pretty compelling. And I would say every meeting that we left, it kind of ended with, we look at a retail center or that shopping center you had last year. Is it still available? So there seems to be a re-interest and a re-emergence of retail this year. And I would, make maybe a prediction that you'll see a comeback in retail this year. So hopefully we can find some because it's going to be tough to build. Not much land left. Yeah, so, prime spaces, I can tell you, I know a lot of tenant reps for good space. There's way more tenants than there are tenants. And then, of course, development is tough. All the development you're getting now is at the base of podiums because there's no large tracts of land. Anything like that, is going to be high-rise multifamily and more value-add land. So you're not going to get a whole lot of new. So I really like retail. I wish I had a lot of it, and I hope we can help you guys find more. So I saved this topic kind of for last, and we can talk about some other things as well. Alternatives, we can get into that. I'd be interested in that, but we'll get there in a second. This is a market that I want your opinions, but let's talk about what you think about it. Again, your wise fund advisor, and this is really comes down to the Broadway plan a lot. But don't build anything where the cost of building it is greater than what you can sell it for. So don't buy high and sell low. That's not bad advice. But that's almost where the pro formas look like today. And don't buy anything where expenses are going to outpace your ability to raise controlled rents. So in one of the most chronic shortage of housing markets in the world, they're not letting you do anything. Give us your views on multifamily, and let's just have a good discussion on that and try not to bash the government too much. Jordan, you're a big developer. Why don't we give us your thoughts? You got a lot on the go.
Yeah. My thoughts generally. I mean, again, the margins are low, but the fundamentals are really, really good. There's just so little space to live. We have big population growth, as you've already pointed out. People need to live here, and so we like it, and it's a critical part of what we do is providing homes to people of all kinds, right? And so, again, we like it, and without bashing the government too much, I think the issue there is really just how hard it is to get something built. That's really it. Like I could go on and on and on, but I just think if a municipality can come up with a clear sort of designation for something that they actually stick to and they don't change, and they go through due process to get it, get that policy approved, and it's even remotely economically feasible, it'll get built, and we like it. Like regulation is really the only thing there that sort of keeps us up, but for the most part, yeah, I think this market is great for it.
Vera, one thing that makes these pro formas work, where the first comment by your wise board members would be able to be fixed, is if we could drop those cap rates on the finished product for multifamily, and then the pro formas would work, and Jordan and Alex would build in a lot more. Of course, Alex would keep his, but you could buy them. How low can you go for a cap rate? I mean, the demand is endless.
So you're saying how low we can go in terms of purchasing?
How low should you go, I think, is more the question. I'm not asking you specifically, but I mean, it seems to me that you've got this leverage issue out there. You don't want to get into negative leverage, but you're poised for unlimited growth in rents.
Yeah, so, we don't have the core, 3 cap yield. We don't have a fund for that. So when we're looking at multifamily, we're really looking
But
more
3 cap's not going to be 3 cap forever. It's going to move up. We can raise those rents.
So, that's where the regulation scares us a little bit. So, all the points that you wrote in your strategy there, I mean, they're valid things that we discussed. But another thing is really, at the end of the day, time kills all deals. And what you've seen is historically in Vancouver, it's taken 7 years for a project to get off the ground. And, who knows, by year 7, you may have a new council, you've got a new mayor, and, who knows what other things that they're going to enforce. So, maybe keep your 3 cap in there forever, because and right now what we're seeing is we do expect that there's going to be a really rapid increase in rent rates, but at the same time, we think that's going to make your tenants stick here. So if we're going to move you in at a 3 cap, we're going to be hanging on to that 3 cap, and maybe it'll be a 3.5 in 5 years. So I'm not saying that that's the case, but those are the discussions that we're having. And I think if we're able to expedite a lot of those approvals and alleviate some of our concerns that we don't know what's going to happen in 7 years' time, I think it would make a big difference.
Alex?
We love multifamily. I mean, we see the long-term growth potential. That's why we're building it. We want to have new, modern product. I think when you talk about regulation, there's lots of it at the municipal level, at the provincial government level. There's a housing shortage. It's a national issue, and I think the solution really needs to come from the top, from the federal government. And if they want to do something bold and they want to improve the economics of delivering rental housing, they should just go and scrap the GST and provide interest-free construction financing with decent leverage with no strings attached, because the strings are already attached at the municipal levels for affordability, for sustainability. That'll make a difference. It won't be popular because the general population won't understand the impact of that, but I think that will help improve the economics of delivering rental housing. So I guess that was if I were Prime Minister for a day speech, but
I would vote for you. You got to give the politicians a little bit of, it wouldn't be very politically sound to appear to be lining the pockets of these greedy rich developers, right? That's an issue that's out there. That's a fundamental issue. But I think they're soon poised to find out that there's going to be nothing built if they continue what they've got going, and then their housing price. I mean, 7,500 doors delivered, and the vacancy rate is less than 1%. So it's just going on. I guess I get back to average rents for new apartments up 30%. So that's there's lots more room for those to go up. That's going to be an issue. Tightest market in North America across Canada. It's just poised for more and more and more growth. I just don't know all the slides here, but Canada set to lead the G7 over the next 5 years on all economic indicators. So more people are going to come. Your economy is going to be better, and we got no place to put them. Vacancy rate of less than 1. So you're building. You're comfortable with where you're going. Comfortable with rates. Would you do more?
Yeah, I think long term, like we're trying to grow our portfolio, and the only way to do that is going to be to build. Like we can't buy existing 2 or 3 caps and have the political sensitivities of trying to
move people
deal with
out,
tenants. So we're building it, and I think that's the only way we're going to grow. So yes, it's pretty hard to navigate pro forma or an underwriting these days. Every deal requires more equity. Costs are up. Interest rates are up. Nothing appears to make sense at this current juncture. But I think if you take a long-term view, where growth is going to come, it's going to come in the form of rental rates moving, and that's going to create long-term value.
People are going to keep moving here to our country. We got a great place to live. Vancouver especially, as long as I've been in the business, we've been in the top 3 places, 5 places, top 7, 5, 7, 3, 7, 5 to live in the world as a city. We don't have the problems the rest of the world had with wars and government controls and close to civil unrest in our neighbors to the south. So we look pretty good. So they're going to keep coming. Where are we going to put them? Vera, how do you convince your board that you should be able to buy some of these buildings at lower cap rates? Because that's all that's going to get Jordan into the ground.
Yeah, so we don't really have any sort of secret sauce, right? I mean, we're 100% real estate company, so it really just comes down to actually having a real story that I can tell in a room. So, if you're saying, okay, if you're buy this 3 cap, it's gonna be a 6 in 3 years' time. I mean, we just gotta have a good fundamental support for that. Like, we know we've got rent control, so how are we gonna execute, in this rent control space? So I think where we've done really well is at the end of the day, Vancouver is a very local market, and there's a lot of local expertise. Like, I'm not an operator, I'm an investor, right? So, and at the end of the day, KingSett, we're capital providers, and having partners locally that can actually tell us, here's exactly how we as Anthem, for example, we're gonna add value, and we are going to deliver that growth. That resonates with us.
Alex, you just keep building for your own portfolio, or any build to sell?
We do a little bit. We have 2 buckets of capital. One's a long-term strategy, one's a merchant strategy. I think building rental on a merchant strategy has just become increasingly more difficult. The margin just isn't there, so you need to take a long-term view. I don't think, like, in terms of our approach or our appetite, like when we go to an investment committee for approval to do multifamily in Vancouver, it's like almost an automatic check. We don't need to write a white paper on why Vancouver. I think it's other markets that draw more attention. There's just so much growth happening here. It's really, like, we're really confident in the long-term trajectory.
You do a lot in the U.S. How is it different down there? And because those markets, to me, aren't as broken as this one. And maybe some of the examples of what's happening down there could help things they do differently that make that work and not work here.
Yeah, I mean, I think the multifamily that we own in the U.S. is all in right-to-work states where there's no rent controls. And so, unfortunately, the consumer or renter bears the brunt of that. But it allows the rents to move, and it gives a lot of confidence for capital to go into the market. At the government level, they also can approve projects quickly. So in some cases, if we're building in the U.S., we're buying and closing on a site with a building permit in hand and starting construction the next day. Like, that's unheard of here.
Yeah.
So you can deliver new supply to the market. So it's a blessing and a curse because there is more new supply there, and so you are competing with that.
Yeah. Jordan?
Yeah, I agree with Alex. Like the regulatory.
Well, you're in Alberta, so you don't have to go south of the border.
We build rental in California as well.
Oh yeah, right. Sorry.
And like even in there, it's like highly regulated. But next to Vancouver, it's like the Wild West. And so to Alex's point, like that side of it is really, really, really good. There's less rent control, and we like it. The only difference though there, I mean, in some core markets, you might not have to worry about this as much, but down there, there's less constraints on supply, and people move around a lot more. Like in Canada, we only really have a few big cities that people can live in. And so it sort of acts as this nice backstop. Whereas down there, people stop moving around if there's no jobs, and things can get soft a lot more quickly. And then the lending environment down there is definitely more, I'll say, sensitive to headlines and all things like that. Like I think they got burned really badly in the global financial crisis, and there seems to be a lasting sensitivity to that. And so like that's where it's challenging. But again, just because of the economy's so much bigger down there and the regulations less, we do really like it and are still going there.
Yeah, I mean, the supply issues there are driven by market forces, right? If there's lots of demand, then there's lots of capital, the lenders will move in, the developers will move in, and they'll build rental. And they're not hampered by all these government regulations. Here, the powers that be have been trying to control the supply side. And, how successful, Alex, has CMHC been with all these programs? Is it
I'd go back to my previous comment, so probably not very successful.
not enough, but they're trying.
Yeah, I mean, the MLI Select program is good, right? So we're taking advantage of that where we can, but it's all about the approval, whether it's approval at the municipal level or trying to get your application in for CMHC. Everything takes time here, and time's money, and it takes too long to deliver product to the market. That's the issue.
Vera?
Yes, we echo the same thing. I mean, the biggest issue for us is really time, because again, we don't have a very, very, very long-term pool of capital that can wait, 10 years before we see success. Like, it's got to be something a little bit more imminent. Like, one thing that I was talking about last week, the City of Vancouver, is some of our policies, for example. Like, we go through this huge program of approving these OCPs where you have a public hearing. And then when you rezone under the OCP, you have a public hearing again. Like, what was the point of doing that in the first place?
So they can get the CAC money.
I mean, if you want housing or do you want CAC money? Like,
I think they've made that call. So it is tough. It is difficult with the cities. I can tell you, and I don't, this is maybe the only topic where I have some kind of an opinion, but we've been following that Broadway plan, really, really close for a long time. And when we started out, we would meet a bunch of, the Broadway plan, all of a sudden I can build a 26-story office building on Broadway, and I may be one of a 50-foot owner, I'm one of a 100-foot owner, and if we can get together, I get 150 feet, I can build this tower. So you saw all kinds of people coming out and putting their sites on the market, developers going out and tying up 1, 2, or 3 sites, just as it got approved. And as the approval process went on, the first time people would come to say, hey, you can sell this for me. Well, yeah, I thought we could get them to a 150-foot site. A number that I remember was about $33 million. It was about $260 a buildable foot. Everything worked. The pro forma worked, the residual worked, everything worked. As time went on, they added more regulation, more rules, more time to market. You're going to hear from your planner in January. Now it's going to be April. Now you got to move your tenants. You got to bring them back. It just keeps going. Construction costs have risen. That same $33 million has fallen. For a while, it fell to about 180, and a lot of sites got tied up. That took it down to about 24. So the poor landowners just lost about a third of their value. Today, that pro forma is probably running around 14 or 15 million. So it fell more in half because of the regulation and the process. So what you have, which is fascinating, Jordan, Alex, no sellers. You got no sellers. You can't buy any land. Because why would you sell it? Because I got to pay taxes and I can't put money. I might as well keep my 3-story frame walk-up on there because I'm doing better off. So when you have no sellers, lots of guys here willing to build, lots of money willing to build it, lots of guys willing to go, know what they're doing, smart. They can't buy any land because and rightfully so, they won't sell it. So somehow along the way, I think the regulators missed that point. So they're not going to get these CACs if nothing gets built. And they're not going to get their 20% affordable housing component unless something gets built. So, I don't know, just put up your hands here if anybody sits on or knows somebody sits on a committee that's lobbying the government in various ways to change the regulations, change the rules. Show of hands. Jordan, yeah. I thought there'd be a lot more. Maybe that's a problem. Maybe there should be more people lobbying. But we are trying, we are talking to them, but really, Alex, what do you hear? Are we making any headway? Is the city thinking of relaxing CACs, cutting back on some of the costs? Is the government going to eliminate GST on new apartments? Is there going to do anything to help fix this?
I think within the city of Vancouver, what's really encouraging is maybe revisiting the view cones. Because
I heard that.
I think Mayor Ken Sims at least got his heart in the right place. We all acknowledge there's a housing crisis. I don't know that there's a view cone crisis right now with views of, how important is it to see the view of City Hall from Science World? Like, is that really important? So,
it's amazing. I was was invited to a ribbon cutting at the building Great West Life built on Robson Street years ago when they started. It's finished now. I think they're getting $7 a square foot on the top floors. The market's gone really well. Everybody did well on that. They brought the mayor at the time, Kennedy, to cut the ribbon because it was rental. It wasn't that many. I think it was maybe 110 doors. It wasn't that many doors, but he came there to cut the ribbon. Look, rental housing, he took the credit, even though the deal had been many years ago. And I had St. Paul's Hospital for sale at the time, and it was zoned for 2 million feet, and the site could easily take 4 million. And I thought, what a great opportunity for the city, getting to upzone it, solve a housing crisis, get a lot of headlines, best site in the city, high point. And he said to me, I talked to one of my friends from Great West. They got me a little meeting with the mayor on site. We're all outdoors. And he came over with a security guard, and I told him who I was and what I was doing and what I thought. And he said, I heard about that. And he said to me, you know what? We don't have a view cone crisis. We have a housing crisis. And it's exactly what Ken Sim just said and exactly what we've been hearing. And yet nothing ever got done.
We also don't have a shadowing crisis either. And apparently we're worried about 5 minutes twice a year of shadowing on parks.
Oh, no. Yeah, we've all heard the horror stories, right? So when it comes to this chronic shortage of housing and, 100,000 people moving here and no homes, no place to live, but really is the relaxation of density, view cones, shadowing, is that going to fix it? I mean, they're still going to charge a big CAC for that. I still can't sell it more than what it costs to build it if Vera's not going to go under a 4 cap. So, Jordan?
Well, so I was there like, I'll try to answer the question I think was in there.
Well, they have to do more than just view codes. I guess that's really the question.
Yeah,
How much more do they have to do? I'm trying to get to that, right?
Well, I think, yeah, they got to do all that. And again, their decision, I don't want to go on this for too much. Their decision-making process within City Hall, particularly in the city of Vancouver, is like a kind of a joke. But, it's on us too. I think the reason politicians and staff and all that are so resistant to making all these changes because they don't feel safe making those decisions. And I've said this before, but I think we as an industry, we're really good at putting together an articulate, argument for why it should all be happening. And it's true. The math's all there and it makes sense. But I think we could probably do more just getting on the ground, in the community, talking to people, listening to them, showing some empathy, establishing a human connection so that we're not just the faceless, greedy, evil developer or whatever, and build some trust and try to solve some of their issues, and hopefully they'll allow us to solve some of ours. And so the more we do that and the more the public kind of places a little more trust in us, the more they will support politicians to make those decisions. Because what we've been doing for 6 years in the way of just bitching about it hasn't really worked as much as it should have, I think. So yeah, I think that's sort of what we have to do, which is way more work. It takes time, but I do think that's probably the only way out.
Well, I think that one thing we need for sure, and I agree with all of that, is, next time I ask this question, more hands have to go up. We have to get more involved and let them understand that it's not we just can't build anything, in my view. Let's move on to just buying a house, because, Jordan, this is really what you're in, and there's some build to sell, some condo business. Basically what this says is that nobody in Vancouver can afford a house to buy, period, full stop. You need, to buy, I guess that's the stats. You need $365,000 a year. If your income could be 30%, to whether you want to buy a house, a condo, whatever it is, and the average income is well below that. So basically, nobody can afford to buy anything in Vancouver if you go by the averages. Of course, we're still doing deals. I think you just mostly sold out a kickoff project in Burnaby. But why are you building this stuff if nobody can afford it? How is this working? I'm just curious. And is rental going to be the only solution? But geez, we just talked for 15 minutes on why rental won't work.
Well, I think it's been a lot of work, but we're having success there, and I think that's where pre-sales are, we believe is a good opportunity for people, because you're not putting up all that cash up front. You're putting down a deposit, you're working, you're saving, your parents are probably giving you some, and that's the other side of the story when you look at stats like that, is that there's been a huge wealth generation among the older generations that are now passing that on to their kids, and then people are moving here with money and they're buying those homes. So we believe in it. Again, there's a fundamental housing shortage, and so more and more we're building condos, but we also build rental, within those communities, and by having sort of that mix of housing, and that's another good way to get a rental, right? Is your financing's not just relying on that rental income stream. you know, that it's on the back of the perceived condo sales and all that stuff. So again, not a lot of housing. There needs to be more of it, and we just believe in those fundamentals. And our policy is just to always be in the market and going. And sometimes that means you get stuck for a year or whatever. And that's why, you know, you diversify and you buy income property and keep things going elsewhere. But then you're there when the market does come back, and always comes back, you know, I think, because people need places to live.
They definitely need places to live. You know, would you agree? You're in the capital stack for some of these built to sell. It's not all investment for you, Vera, and you see these kind of statistics. And now the government's added another layer: no foreign investors. You know, really a lot of fun. Foreign investors are often a large part of your pre-sale opportunity, and they would buy it and then they would put it on the market. They'd add to the rental stock. The government somehow thinks it sees fit to stop those guys buying, so he can't build as many, or these guys can't build as many, and they can't rent anymore. Are you still a believer in a condo project in Vancouver or Toronto or?
Yeah, for sure. I mean, for the right product, the right location, the right price point, you know, I'd probably be a little bit less comfortable looking at downtown product where it's, you know, a couple $1,000,000 per pop. But for example, South Yards, you know, where your one bed is still, you know, call it $700,000, you know, $700,000, and you know, we've got, you know, nice outdoor space. Like, I hate to say that life is priceless, but in a way, you're making a choice to maybe go slightly smaller to be in Vancouver.
Yeah.
And if that's still okay with you, you're still going to be there. And you know, like Jordan said, there is a lot of that, I guess, second generation wealth. Like, I hear a lot of this anecdotally where, you know, someone's mommy is going to buy for her child as a pre-sale in a couple years' time, because again, we don't have that many major markets. If they want to stay in Vancouver, they're going to start investing very early. So, you know, by the time that child goes in, that deposit's actually already paid for. So it's slightly different math.
So with foreign buyers of the market, our entire housing market is relying on the bank of mom and dad.
They're not foreign, though. They're
That's
local.
That's what I'm hearing.
A lot of it is.
Yeah, interesting. Very, very tenuous. Okay, well, we know the government's a big part of the problem, so we don't have to dwell on that. Alex, give us a couple of minutes just as we go towards wrap up here on alternatives. You're very, very big in alternatives. Tell us about the markets that you like, and if you see more opportunity because there's less players in them, because you already have a foothold, are you looking to grow? And Vera, would you invest with these guys in alternatives? Alex?
So great question. Our favorite asset class is self-storage. Like, we love the fact that people want to spend $500 a month to store $300 worth of junk. It's fantastic. It's amazing. But we own and operate 8 locations in BC under the Advanced Self-Storage brand. It's great. There's been amazing top-line rental growth. The biggest challenge is getting scale. And so that's what we like about it. There's a lot of barriers to entry, and there's no regulation on rent control. Once you have scale, you can really push values and push rates. So it's a great asset class. We have a little bit of seniors housing. It's not really a core strategy for us. It's really self-storage.
Vera, alternatives?
Yeah, so historically, we haven't been super big on alternatives because we see ourselves as like experts in real estate. But when it comes to a large operating component, it's a little bit different, you know, like seniors housing. But with that said, in an inflationary environment where you're looking at alternatives like hotels, I don't know if hotels really counts, but you know, hotels and self-storage where you can, you know, reset that pricing instantaneously according to the market, those have been looking quite interesting. So we started to revisit looking at some of these asset classes.
Capital's always trying to find a home. Jordan, do you need any alternatives? Data centers, cold storage?
We've owned, not so much self-storage, but I agree with everything Alex said, but we're certainly not a hotel-based company, but we're looking at that more and more. We own one hotel, so if anyone wants a discount at the Holiday Inn Express in Metrotown, let me know. But it's even through COVID, it survived, and now it's doing really well. And I think you know, people like to travel again. It's that experience thing, and so yeah, we'll look at that selectively. And we're always we're opportunistic. We'll diversify wherever we think we can, you know, make some money. But yeah, I'd say that's about it on that front.
Okay, well, we're just about out of time. So, you know, I read somewhere, I don't know it was Will Rogers or Yogi Berra, one of those famous offbeat philosophers, that predictions are easy unless they're about the future. But we're going to ask you to make a prediction. Political leaders said last year inflation would be temporary. This is Janet Yellen this year with Will Blitzer. I think I was wrong. So we know they're hard. Even the experts get it wrong. But I'm going to ask you guys a prediction. We'll go across the board really quickly, and then we'll have time for any questions if there's anybody here. The bank rate today is 4.5, higher or lower this time next year? Jordan?
I'm hoping it's lower.
Hope is not a good strategy. I was told that
I
by a
think-
wise investor.
I think it'll be about the same or a touch lower, based on everything I'm seeing and reading and all the data. I feel pretty strongly that's what'll happen. But like if inflation does seem sticky. We've been surprised before, but I think that could go both ways as well. So I'm thinking about the same or a bit lower. That's sort of what we're planning on.
Vera, the wise think tank in Toronto and deep in the fund management business, what are they saying, higher or lower?
I think probably the same. If I were to guess, I think maybe we'll have another, minor rate hike, and then it'll go back down again. So kind of an up and a little bit flattened out.
So prediction is the same? Alex?
I for sure thought
The
both of you
World
would've
of Public
said
Wealth,
lower.
you have a huge research at Nicola Wealth. They're looking at it every day. What do you guys think?
I would have for sure thought you both would have said lower, because I think the same. I just think that the bank isn't going to lower rates as quickly as we think. They're really watching inflation, and it's going to take time for this to play out. So given how quickly they raised rates, I don't see them coming down as quickly.
Okay, I think they're going to be lower, but my opinion doesn't matter. But I guess I have to say that if I'm going to get you guys to buy anything and reduce your cap rates a little bit so we can actually get stuff done. All right, look, thank you very much for all of your time. We've got maybe a minute left. If there are any questions, there's a roving mic. So 3 very, very wise panelists, all with heart, brains, and courage. Any questions? Okay. Thank you very much for coming. It's been a slice, 9:30. Paula?
Thank you very much, Tony, and you ended exactly on time, so perfect. Thank you. You're always an esteemed and distinguished moderator, and thank you for having engaging the panel in such an insightful conversation. Panelists, thank you directly to my right, Alex Messina from Nicola Wealth, Vera Liu from KingSett Capital, and Jordan Carlson from Anthem Properties. One of the comments that kept coming up was about advocacy and the importance of government relations. Just wanted to put a little shameless plug for NAIOP. That's one of the things that one of our core pillars, and we're very actively engaged in that. So, and that is really, that work is largely supported by our sponsors. So again, thank you to our sponsors. Thank you to all of you for spending your morning with us. We look forward to seeing you at our next breakfast, which will be occurring on March 9th. The theme will be retail. So I hope you all have a wonderful morning. Thanks again to our moderator and our wonderful panelists and the insightful discussion.
Thank you.